Hello and welcome. Today, we're going to pull back the curtain on a financial product that you've probably heard about, but maybe don't fully understand. We're talking about annuities. So let's dive right in and figure out what they are, how they work, and how they might fit into your retirement plan.
This is the big question, isn't it? It's the one that can keep you up at night. That fear of running out of money before you run out of time. Well, that fear, that very real concern, is the exact problem that annuities were originally designed to solve.
So, what's the big idea here? Really, you can think of an annuity as a way to build your own private pension. Since most jobs don't offer them anymore. It's a deal you can make to create a guaranteed paycheck for yourself, giving you some serious peace of mind down the road.
Okay, so what is an annuity really? At its heart, it's a contract, a deal you make with an insurance company. You give them money now, and in exchange, they promise to pay you back with a steady stream of income later. And that leads to its most powerful, most unique feature. It's the only financial product out there that can guarantee you an income that you literally cannot outlive.
Now, before we go a single step further, let's get one thing crystal clear. This quote from the official Buyer's Guide says it all. Annuities are a long-term play. This is not about getting rich quick or having easy access to your cash next year. They are specifically built for one thing: creating retirement income. All right, so how does this whole thing actually work under the hood? Let's pop it open and look at the engine. We're going to break down the basic mechanics of how an annuity is built.
For most annuities, there are two distinct stages. Think of it like planting a tree and then harvesting the fruit. First, you've got the accumulation period. This is the growing season. The money you put in has the chance to grow, and you don't owe any taxes on those gains along the way. It's tax-deferred. Then, later on, you flip the switch to the payout period. That's the harvest. It's when you start getting those regular paychecks.
And this right here, this brings us to the fundamental trade-off. There's no free lunch, right? To get those powerful guarantees, especially that income for life, you have to commit your money for a certain number of years. You're essentially trading some access to your money, what the pros call liquidity, in exchange for long-term security. That's the deal. Okay, this is where things can start to feel a little complicated. It's like a fork in the road, and annuities are definitely not a one-size-fits-all product. But don't worry, we're going to break down the main types you'll run into.
You've basically got two main flavors. On one side, you have fixed annuities. They're simple, they're straightforward. They give you a guaranteed interest rate, so that means low risk, but usually more modest growth. On the other side, you've got variable annuities. Here, your money is actually invested in the market, in things that look and feel a lot like mutual funds. So you have much higher potential for growth, but you're also taking on market risk. But what if you're thinking, I want that safety, but I'd also like a little more growth potential? Well, that's exactly where this hugely popular hybrid comes in. It's called the Fixed Indexed Annuity, or FIA. It tries to give you the best of both worlds by linking your interest to a market index, like the S&P 500, without actually putting your money in the market. So you're probably asking, how in the world can they do that? Offer market-linked gains with no risk of loss. What's the catch? Well, here it is. The growth is controlled by certain limits. For instance, there might be a cap, which is just a ceiling on how much you can earn in a year. Or a participation rate, meaning you get a piece or a percentage of the market's gain. These limits are the price you pay for the powerful guarantee we're about to talk about.
And here it is. This is the superpower of the FIA. This is the main attraction. The interest they credit to your contract is guaranteed to never be less than zero. So even if the market index it's linked to has a horrible negative year, you lose nothing. Your principal and your previous gains are protected from those market downturns. Period. Okay, let's roll up our sleeves and get into the fine print. You absolutely have to understand the costs and the optional add-ons, which are called riders. This is where so much of the confusion around annuities comes from, so let's clear it up. Remember that trade-off we talked about? Committing your money for a while? Well, this is the enforcement mechanism. If you decide you need to pull out more money than the contract allows during that commitment period, you're probably going to get hit with a surrender charge. It's basically a penalty for breaking that long-term agreement early.
Now, this charge isn't forever. As you can see here, it's on a sliding scale.
The fee is highest in the first few years, and then it gradually steps down each year, until eventually it disappears completely. And it's important to know, most contracts let you take out a portion, usually around 10% every year without any charge at all.
All right, deep breath. We are now going to tackle what is, without a doubt, the single most misunderstood part of modern annuities: the optional income rider. It's an add-on, usually costs an extra fee, and it's often called a guaranteed lifetime withdrawal benefit, or GLWB for short.
Okay, I need you to lean in for this one, because getting this concept is everything. Your annuity has an accumulation value. That's your real money. It's your cash value that you could walk away with. But an income rider creates a second, separate number. It's often called a benefit base. The best way to think of this is as a phantom value. It's a calculation number. Its only job is to be used in the math formula that determines your future paycheck. So when you hear an agent talk about a 7% roll-up or growth rate on a rider, that percentage is being applied to this phantom number, not your real cash value. Let me say that again. It is not an interest rate or a return on your investment. It's just a calculator.
So now that you've got the nuts and bolts down, let's get to the most important part. How do you actually shop for one of these things? How do you become an educated, empowered consumer and make sure you're making a smart choice?
You need to know this. You have rights. Thanks to new regulations, in most places, any financial professional who recommends an annuity has to demonstrate that it's in your best interest. And that's not just a fuzzy term. It means they have to base their recommendation on a deep understanding of your entire financial picture, your goals, your needs, your age, everything.
And here it is, your ultimate safety net. It's like a no-risk trial period. Every state requires a free look period, which is usually somewhere between 10 and 30 days. This gives you time to get the actual physical contract in your hands, read every single word, and if you have any doubts, if anything doesn't feel right, you can send it back for a full 100% refund. No penalty, no questions asked.
Look, to protect yourself, you have to be ready to ask tough, direct questions. So here are some of the most critical ones you should have on your list. How long is the surrender charge period? What are all the fees? Every single one. Can you explain to me slowly how the income rider works? I see there's a premium bonus. What's the catch? What am I giving up to get that? And what's the absolute minimum guaranteed interest rate on this contract? Get clear answers, write them down.
So, at the end of the day, is an annuity the right move for you? Well, it can be a fantastic tool for some people, and a really bad fit for others. The whole point of this explainer wasn't to tell you yes or no. It was to give you the real knowledge you need to cut through the jargon, understand the trade-offs, and make an informed decision for yourself. Now, you have the tools to start finding that answer.